Hi everyone, Dr. Donna Barris here. Welcome to Accounting 101. This is week 3, lecture 2. First and foremost, I must say well done for your online discussion from last week regarding the various types of expenses. I read every single one of them and well done, well done, well done. Now, for those students who either posted late or didn't post at all, I want to be clear. Per the syllabus that we went through in detail and that I've posted in the content section of Blackboard, if you do not post at all or you post late, both actions will have dire impact on your overall grade. Now, posting late, meaning that you won't get full credit, and not posting at all will tell me that you didn't attend class because there's no way for me to keep track of you attending. So I strongly recommend every single person, especially to those students who are starting off on the wrong foot, to please go through the requirements that are clearly outlined in my syllabus. All right? Now, let's get started. Now, last week, let's do a quick wake up your brain. Last week, what did we discuss? We discussed what is accounting. We said it was the language of business, right? And we mentioned that there are two main types of accounting. We have managerial accounting and financial accounting. Managerial accounting is financial information that are used for internal users, so like your bookkeeper, while financial accounting are financial activities and information that are used for external users, so your shareholders, your stakeholders. The Securities and Exchange Commission, which we'll get into at another lecture. So for today though, we want to discuss businesses. What are the different types of businesses? Oh, there are different types of businesses out there. You could be driving down the street and you pass a restaurant, you pass a Dunkin' Donut, then you drive past a Macy's, and then you drive past a doctor's office, right? All those various types that you just drive past could be a different type of business. Now, for this class and for this session particularly, we're going to discuss the 4 main types of businesses. So there are 4 of them. Get your pen and your pad and let's go. So the first type of business is a sole proprietor. So a sole proprietor is the main type of business. The second type is a partnership. The third type is a limited liability company or an LLC. And the fourth and final type of business that is out there is a corporation. So we have a sole proprietorship, we have a partnership, we have an LLC, and we have a corporation. So what is a sole proprietor? So a sole proprietor is a business that is run by one individual on their own behalf. Or think about it as in someone that owns a business by himself, the mom and pop store, right? Small businesses. Here is a little, did you know? Over 70% of the businesses in the United States are small businesses. They're owned and operated by individuals, and so small businesses are usually sole proprietors. We're in New York, right? And it's an immigrant state. Lots of people that leave their place of birth and they come to this state and they want to start over and they want to be their own boss, usually set up shop, right? So as sole proprietor, it's super easy to create, and we'll go into the advantages and disadvantages of them. But a sole proprietor is a business that is run by and owned by and operated by one individual for that individual's benefit, right? So let's say I can bake, right? And I want to start my own business, and we're going to do Boris Bakery, right? And I am the one that's going to operate it. Even if I hire someone, I am creating and I am making and I am forming a business for my behalf. So think about the bodegas, the restaurants, the nail shop, the hairdressing salon. There's so many different types of small businesses that are more likely than not to be a sole proprietor, right? So what is the advantage of a sole proprietor? Since 70% of the businesses that are running out there are sole proprietors and small businesses, One of the things, they're super easy to create. Oh, I can bake that make Angel sing. And I decided that, you know what, I am going to gather up all my coins and just beg, not borrow, beg some money from all my family and friends, and decided that I am going to open up my Boris Bakery. Super easy to create. I am the legal owner. I am I am legally responsible for all the profit is mine. Yum 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 yum. So all my cupcakes and all my cakes and everything when I sell, and it's a sell through and it is wonderful. All the coins are mine. Here's the kicker though. All the coins are mine. All the losses and the liabilities are also mine. So that's the main thing with a sole proprietor. All the business, good, bad, or indifferent, rest on these shoulders as a sole proprietor. Yes. So everything and anything that you do, it's on you. So my income that I get from the business, I would have to put it on my personal tax return, which is my 1040, the average one that everyone does, the most people does, whether it's a loss or anything. If somebody can't come into my restaurant and slip and fall, oh, I didn't have a restaurant, I had a bakery. Someone come into my bakery and slip and fall, or they said they got food poisoning, God forbid, or anything, I absorb all the loss, all the gain, everything, the good, the bad, the indifferent, as a sole proprietor, right? So there's some good, super easy to create. All the coins are mine. There's some bad. If somebody is deciding to sue, they're going to sue me, and they can take away everything from me, because in the eyes of the law, the business and the owner is basically the same entity. So that's actually a great way of thinking about the sole proprietor. So in the eyes of the law, the business and the owner is the exact same entity. So you get the good, you get the bad, and you get the indifferent. All right. So that's a sole proprietor. Now a partnership. Now let's say nobody slipped and fall and nobody got stomach ache, or nobody decided to sue me with my Boris Bakery, right? Because it was just fabulous. And I've been doing so well. And people come in and they're like, ooh, Boris, your bakery is on the spot. You know what would make it even better? It's too bad you don't even sell anything other than baking cakes and cupcakes. I can't live on cupcakes and cakes all my life. And I've been thinking about it. And I'm like, yeah, but between you and me, I can't cook. But my bakery is fly. And then I know someone who's just like, you know what, I actually can really cook, but I can't bake. And I feel like the place right next door to me is renting out. And I want to expand and I want to grow. And I'm thinking, you know what? You can cook, but you can't bake. I can bake, but I can't cook. What are we feeling? What are we thinking? What do you think we should do? I got it. Let's go into business together. So that brings us to a partnership. We're not at a partnership yet. We're at the formation of a partnership. So a partnership is a business relationship between two or more people where the functioning of the business is governed by a contract. Underline that part. The functioning of the business is governed by a contract. And I am saying a contract that is written, that you sign, that I sign. Because let's discuss. I've been in business and I've been doing my cupcake for a long time, and everybody knows me. So you're not just going to open up, and I'm not going to just put you there and then we don't discuss, are you going to get 50% of it? The devil lie. I've been around for a long time, not judging. Are you going to absorb? Who's going to pay the rent? Am I going to pay all of the rent for my bakery over here, but I'm going to have to pay half the rent when we're renting out the next place next door so I'm paying all of it over here and half of you over here, and you get, so there's so many different things to iron out. And that's why before the partnership becomes a partnership, all the functioning of the business have to be written down, agreed on, discussed, and signed in a contract. in a contract. And I'm not telling you what to put in the contract. The only thing is the two or more people that are a part of it that will want to be at the partnership have to discuss the contract. Once the contract is signed and we shake hands, we go from Boris Bakery to Boris and Friends Bakery and whatever we want to put in the name. Even the name has to be governed by the contract. So the main thing with a partnership is the ins and outs of the business has to be put in writing, and it has to be signed. So what are the advantages and disadvantages for a partnership? So the partnership is pretty easy to create and maintain. You walked into my restaurant, you walked into my bakery, I know you, or you're my friend, or I went to your restaurant and I think you're fabulous, or the place next door was opening. However it is, we decided to go into business together. It's pretty easy. We discuss who's going to do what, how we're going to split up the profits, the loss. We discuss all of that, and once we write it down and we sign it, we're in a partnership. So it's pretty easy to create. There are usually no fees associated with starting up a partnership. The owners can report loss from that partnership on their personal tax returns, so you can offset it. As for the disadvantage, though, all owners are responsible for any liabilities or debts or judgment that comes against the partnership. So even though, remember I told you I can't cook? Now let's say somebody walked into our place and, girl, I don't know, you were having a bad day, and whatever happened to their food, they already told you that, God forbid, they are allergic to something, and you put it and they have an allergic reaction. They didn't die. They are allergic or anything. Even though I didn't cook it, my name is on it. They are coming after our partnership. So all partners are liable for any debt, any judgment, any liability against the partnership. One of the things, though, if a partner dies or a partner decide that they want to leave, that partnership is dissolved. So even though the business might still be going well, let's say I'm deciding, you know what, girl, I can't deal with this. I want to back out. And she gets somebody else. That contract that was very clear, we can rip it up, even if I'm giving my portion to somebody else. In the eyes of the contract, that partnership has dissolved. And even if you just print out a new contract with a new person's name, once you tear up that partnership, that contract, that partnership dissolves, right? And you have to have a new partnership. So people are still coming into our bakery. Let's say I decided to sell out my bakery to her or somebody else. People are still coming in the bakery. They don't know what's going on or anything like that. But in the eyes of the law, that partnership would have to be resolved, and you sign a new contract with all the parties that are going forward. So if a partner dies, the contract has to be reworked. Does that make sense? Great. Now let's discuss LLCs, or limited liability company. So the great thing about the LLCs is that it's an independent legal structure that the business register with the government, saying that only a limited amount of liabilities can fall to the owners, to the members, right? So the members, as it says in its name, limited liability, they enjoy only certain and specific liabilities you can come after with an LLC for from the members. So think about the sole proprietor. You walked, you slipped, and you fell in my bakery when I had just the bakery. You come after me, because in the eyes of the law, that business and the owner are the same entity. For the partnership, even though you got an allergic reaction with my partner, because she's the one that cook, I don't cook, I bake, even though it's a partnership, you're coming after the partners. Now with an LLC, there are only certain liabilities that you can come after with the members, because they're registered, and in the eyes of the law, it's an independent structure, so only some things you can come after the owners with. So the owners, though, for the LLC, they must record their share of profits on their personal tax return, right? So you have to put on it. So it almost like they call it almost a double taxation because they can tax the LLCs and then the owners with their share of the profit, they have to put it on their tax returns as well. So they get hit a second time. So it's definitely more complicated to create, but it has some great benefits to offset that. So that is limited liability company, where it's an independent legal structure where in the eyes of the law only a limited amount of liabilities can come towards the members. Now let's discuss the big one. Now a corporation. Now everybody knows what a corporation is. Now in the eyes of the law, the corporation is a separate legal entity. And you're like, wait, what does that mean? In the eyes of the law, a corporation is a separate human being. It never dies. It is the hardest to create and to form. But one of the ways to think about it, it is a separate human being. It is a separate legal entity. Now, 10%, now in the United States, 10% of all businesses are corporations. But here's the kicker. The revenue, they generate about 90% of the overall revenues in the United States. So 10% in regards to quantity are corporations, but revenues is about 90%. So that tells you how big and monstrous a corporation is. Now, let's take one of the big corporations that we were discussing. Let's say Macy's. Now, if you slip and fall on Macy's, I don't think Terry Longren is still the CEO, but whomever, no, I think it's Felicia. Doesn't matter. So whomever is the CEO or even the owners or the shareholders for Macy's, if you slip and fall, you are not personally suing them. In the eyes of the law, you're suing Macy's. So that's one of the big things about a corporation. They are a legal separate entity. They pay their own separate taxes. Oh, you don't believe me? For you to create a corporation, you actually first have to find a state and you have to file articles of incorporation with the Secretary of the State. Oh yes, so a corporation needs a birth certificate. It's called the Article of Incorporation, and you have to file it with the Secretary of that state that you want to give birth to the corporation with. You need a specific lawyers for you to go over the paperwork. It is insanely expensive, complicated. There are so many guidelines and guardrails you have to go over with a corporation. And this is why that in regards to quantity, it's about 10% of it because of how complicated it can be. But the big thing about it, it's a legal separate entity. On the tax returns, we don't want to discuss one of the big workarounds in regards to the owners and the members. You can buy share and be a part of the owner of that specific corporation, because usually you have different types of corporation. If it's a publicly held organization, you can buy and sell shares of it. But the owners usually can find workaround that they can lower paying income tax. Not here to judge, just here to discuss. But the main takeaway with a corporation is that it's a legal separate entity. So that's what we wanted to discuss today, the 4 main types of businesses that are in the United States. We have our sole proprietor, think about it as our mom and pop or bodega. You have a partnership, you have an LLC, and you have a corporation, right? So there are advantages and disadvantages with any and all of them. Now, what we're going to do for this week's discussion, you, in addition to the lecture that I have just given, are going to do your independent research, and your online discussion will be on, you guess it, the different types of businesses that are out there. Good luck. Please do your research. If there's any question where you do not understand anything that I have discussed, I would recommend you reach out to me via an email. But please, in this setting, you also have to bear some of the weight in regards to doing independent research. Thank you very, very much. Read up on it, especially for those people who want to become entrepreneurs. I can feel the question is going on. So, Dr. Boris, what about if I expand? If you, as opposed to doing a partnership, why didn't you open up a second branch? That's a franchisee. So there's so many different ways that could be a possible franchisee, or we just have multiple branches of my bakery. So that's what I'm trying to tell you. There's so many different ways. Do I do a partnership route? Do I do an LLC route? Do I just have different locations in regards to my bakery? There's so many possibilities, but the main thing you want to do now is understand the different types and the pros and cons with every one of them. All of this is important because I guarantee you someone in my class with my 34 students that I have want to open your business. And before you open your business and be like, well, a sole proprietor might be it for me. Maybe, maybe not. Maybe it would be a limited liability company. That would be more your best route. I can't tell you because I don't know the ins and outs of it. Again, my class is not just to tell you how to pass this class. I am injecting knowledge in you. So for all my future entrepreneurs that are out there, before you even start your business, do your research. Is it beneficial for me to be a sole proprietor? Do I want to go the partnership route with a contract? Or do I go an LLC where I only have limited liability? It's a little bit more complicated to create, but what is better for me? All right. So all of these are just something to whet your appetite in. And I hope you understood. And if there are any questions that you still can't understand after doing your independent research, feel free to reach out to me via email. Okay. Thank you guys very much.